Just the other day, Bill Pulte talked about the 50-year mortgage, sent everybody in the housing industry crazy. However, the thing that he just talked about, portable mortgages. Portable mortgages are interesting. We'll talk about them. We'll give you an example. Portable mortgages is something I think I first talked about 5 years ago. And I believe, frankly, that the portable mortgage has a chance to be that spark that releases the animal spirits of the housing market. As you know, the housing market is broken. It's been broken for a number of years. We've been sitting in about 4 million sales for existing homes for 2 or 3 years now. Yes, we've bottomed. Yes, we're getting a little bit better, but it's nothing like what would happen if we got portable mortgages. So what is a portable mortgage? Well, first and foremost, there are several flavors of a portable mortgage. I will give you one example, the example that I think is most likely. So a portable mortgage basically says, hey, Mr. and Mrs. Homeowner, during the pandemic, you bought and or got a refi at 2%. And maybe you have $200,000 in debt at 2%. A portable mortgage would allow the homeowner to take that mortgage with them to their next home. Interesting. As you know, the housing market is broken because a lot of people are quote unquote locked in. They have reduced shelter cost and they have no motivation to leave. And frankly, many of them could not get approval for a new home at 7%, like they could at 2%. So the portable mortgage says, hey, we will take it from house A and put it on house B. Okay, great. Typically, house B is more expensive. That's where the questions come in. A, you could make up the delta in simply equity, meaning you could put more down. Let's say, let's try to give a real example. So you have a home that's worth $400,000. You have $200,000 in debt. You want to buy a $500,000 house. Okay, great. So you're going to sell, and we're going to ignore taxes and sales, commission and all those fees. We're going to make this super uber simple example. So you sell your $400K home. You put $200K down. You have your $200K at 2%. Well, what about the $100,000? Well, A, you could put that $100,000 down in cash, right? Could be equity. B, you could get a second mortgage. That second mortgage could be for any balance between 0 and $100,000. Now, folks, you are going to have to get very good at doing what's called a blended interest rate calculation, because in this example, you have $200,000 at say 2%, but you have $100,000 at 9%. And I did not do the math because I'm coming up with this example in real time, but there's a chance. Well, let's see, what would that math be? So you have $200,000 in debt at 2, you have $100,000 at 9. Your blended interest rate's probably 5 and 8, something like that. So again, that could be lower than traditional rates, which today are at 6%. So that's just one example. I really do believe a portable mortgage could ignite the housing market. It could take a lot of people off the sidelines and have them start doing move up transactions. In fact, it could ignite the low end so much that supply comes on quickly and you actually get some soft prices, right? One of the reasons the median home price has been so elevated is because we've had a distorted product mix. We've had the high end and mid markets transact where the low end has not transacted at traditional levels. That artificially pushes the median home price higher. So again, just something to think about. It's really interesting to me because when I think about mortgages, you could do the 50-year mortgage. You can extend the term. You could do assumable mortgage, which we do have some of those today. A company called Rome is helping with that. And now we're talking about portable mortgages. And to my knowledge, I don't think we've done portable mortgages in the United States ever. So this would be a net new thing. The banks, the lenders would have to get involved for sure. But again, it is interesting to think about. National Association of Realtors chimed in on the 50-year mortgage, like you knew they would, and once again reminded us that it really doesn't matter because the average term is 8 years. Yes, we hold our loans for 8 years. Today, maybe it moves to 11 years. But again, not many people are holding their loans for the complete duration. More and more government folks like Scott Bessent, President Trump, and others are talking about a $2,000 dividend. Yes, folks, it looks like, again, more and more chatter, looks like a $2,000 dividend is coming to families that make less than $100,000. Again, I think that will be called households making less than $100,000. I'm in the camp of keep the money, pay down the debt. That's what we wanted. We want to bend the curve. We can't see our debt get away from us, and it seems to be, what is it, 38 trillion or something now? It's just wild. Saw an interesting report in The Economist. Yes, an interesting magazine, but rather boring, right? I was a subscriber to The Economist for years. Always in depth, lots of numbers, but kind of blah. Anyways, report they had today or yesterday that I read, investors over 70 own 39% of stocks in mutual funds. I find that very interesting because typically speaking, the older you get, the less risk you want to take. Now, obviously, our stock market has been a rocket ship since the pandemic. And, it's been a very wise move. But again, as somebody who's lived through a couple of bear markets, somebody who's invested through a lost decade, you might be forgetting what the downside risks are of being so heavily invested in stocks. That's all I got to say. I saw an interesting report about the average American, and the more and more reports I read about the average American, the more and more happy I am not average. The average American spends $1,700 a year on food delivery. That's $142 a month. So I'm asking my audience right now, do you spend more or less than $142 a month on food delivery? I honestly can't remember the last time I paid for food delivery. It had to be during the pandemic, I'm sure, but not in years. So do you spend more than $142 on food delivery? Just curious. We got lots of Fed speak. Again, we have a divided Fed. More and more people are realizing it now. Even Nick from the Wall Street Journal is talking about it. So let's figure out who's who in the zoo. Fed President Collins, I have not seen downside risk in employment. Ooh, really? Okay, that's shocking. Did you not just see what Goldman Sachs said in ADP? But hey, okay, Fed President Collins. I expect a modest rise in unemployment next year. Okay. Fed policy is mildly restrictive. Relatively high bar for any additional easing in the near term. You could put Fed President Collins in the no cut in December camp. Fed President Perley, at some point, the Fed will need to expand the balance sheet again. Folks, that is called quantitative easing. Bank reserves are no longer abundant. Ouch. Are we seeing more and more cockroaches to Warren Buffett and Jamie Dimon? Fed President Bostic announced he will retire when his term is up on February 28th, 2026. That will be at the end of his 5-year term. Thank you for your service. Next, he says, firms are telling the Fed the policy is restrictive, especially in interest rate sensitive parts of the market, like housing. Don't see a severe labor downturn as most likely near term. I'm guessing you could put Bostic in the no-cut camp. Of course, we have Fed President Moran, who is in the let's cut 50 camp, saying Fed policy is too restrictive. We also got to this morning comments from Fed President Hammack. I am worried about the labor market. I think you could put Fed President Hammack in the cut December camp. And Fed President Daly reminds us that service inflation has not been declining at a steady clip. And she says it's premature to call for a December cut. So again, I think if you think about the 12 voting members of the Fed, we probably have 8 that say no cut and 4 that say cut. So it is going to be an interesting Fed meeting here in December. We did get some earnings we should talk about. Cisco Systems being the big one from yesterday. Beat top line, beat bottom line. Said it's an incredible surge in orders for AI infrastructure. Not only did Cisco beat top and bottom, but they raised guidance. How about for folks that have silver? Pan American Silver beat top line, bottom line, and actually raised production estimates to 22 to 22.5 million ounces for the year. We also got Disney this morning. Disney missed on revenue, but beat on earnings. Experiences, parks, up 6% year on year, having just got back from Disney World a couple of months ago. Shocking how expensive Disney World is. Shocking how expensive it is. JD.com beat top line and bottom line. CEO says growth of users and shopping frequency. Strong growth in users and shopping frequency. And finally, gambling.com missed on revenue, beat on earnings, and cut guidance. That's never good. Let's talk about our school community real quick. We are nine folks away from 500. All we need is 9 members to join, and we will do an event next week with some millionaires and all that fun stuff. So do me a favor, sign up. Let's get started. You got the weekend. You can introduce yourself. Here are topics that the community was talking about when I looked this morning. Let's compare hem lane versus base lane. How about a new member introduction? Talking about out-of-state investing. Shout out Jared for asking members to invite others. He highlighted that we were at 491. Had an experience after starting a loan. There's an avalanche of phone calls from other loan brokers. And somebody shared their ADU first inspection experience. So again, folks, we are a community of wealth builders. We are doing all kinds of things. You know you need to join. You need to be around other wealth builders. So start today. 9 of you sign up. We'll do something fun next week in the evening. And I hope to see you there. To that end, Raymond and Jacqueline, thank you for joining yesterday. Make sure you introduce yourself. Thank you for being part of the first 500. We just need 9 more. Last thing I read this morning, Michael Burry. We've talked about Michael Burry like 3 times in the last week. Well, he is shutting down his hedge fund. Shutting it down. In his very short letter, he says, my estimation of value in securities is not now and has not been for some time in sync with the markets. To which I'm reminded of, I think it's a Warren Buffett quote. It might have been a Charlie Munger quote. One of those 2 gentlemen said, the market can remain irrational longer than you can remain liquid. Even a hedge fund, even somebody as good as Michael Burry can get wrecked by the market. So again, I'm reminded of that quote. I think it was from Munger, I think said that. But anyways. Lastly, I did read an Economist poll. Again, I did read a couple of articles out of the Economist. Q1 expectations from 105 economists, 52, or about half, think the Fed will cut in December and cut in early Q1. 84 of 105 expect a December cut, which I thought was interesting. So again, folks, see you inside school. Don't forget to buy your tickets to our February event. We are 3 months away from the ORaaT celebration. Get your tickets, book your flights, get your hotels. Vegas is on sale, so save some money. Secure your tickets, get your flights, and we will see you in Vegas. And of course, Steadily Insurance is the sponsor of the Daily Financial News. If you are a landlord or have a property in contract, it's your job to get the best insurance at the best rate. That means call more than one insurance company. So give Steadily a shot, see what they can do for you. They help Olivia and I about 60% of the time. Take care. Thanks. Later.